Over the past week, SoFi has had two major pieces of news. Firstly, they partnered with Visa, which we're going to talk about, and secondly, they announced their third quarter earnings report date, and immediately off the bat, there is some variance from previous quarters to this one. In addition to both of those things, I've been plugging in some numbers in terms of what we can expect from an earnings report for SoFi, for their growth in members and their growth in total products, and I want to share some of those details with you as well, so let's jump right into it. First, let's start off with the Visa news, and then we can spend the remainder of this video talking about the third quarter. Galileo announced on Tuesday that they'd received their Visa Ready certification as an issuer process for its Payments Cards as a Service API. In the press release, they stated that this would allow Galileo as a business to further its partnerships with innovative payments players in the evolving payments landscape. Through Galileo's flexible APIs, clients can create a custom multi-product solution including card issuing, payments, checking, savings, deposits, digital banking, lending, and future products as well. And so at a high level, what this means is once they receive this Visa Ready certification, it basically adds further validity and awareness to Galileo, as Visa is pretty much the largest player in the space. Galileo's chief revenue officer also highlighted in the press release that, quote, "By becoming Visa Ready certified, we are solidifying our current and prospective clients' trust in choosing our next-gen digital and core banking platform." The press release continues to add that with this certification, Galileo is able to accelerate its payments processing platform to provide an exceptional customer experience across digital banking, payment processing, and cards issuing. So just clicking on the link in the press release, it takes us to Visa's partner website, and immediately off the bat, we can see that the Visa Ready Partner Program consists of over 500 different partners in over 11 different verticals. Visa even has a partner directory off of this entire network, and ultimately this is where Galileo will now play a part, providing many positives immediately off the bat. Number one is awareness, right? Visa is the biggest in the space. Galileo being associated with Visa grants awareness. Number two is validity. Visa has a certain standard of excellence, and the fact that Galileo is an official partner further proves them. Number three is the cross-pollination of partners. By being in this directory, so many of Visa's existing partners will now see Galileo and treat it more seriously. And finally, number four is reputationally speaking. Now that you're associated with some of the biggest names in the space, that's also going to have a boost to Galileo's reputation, especially since there are not many companies on Visa's list that provide Galileo services. Anecdotally speaking, news like this, how I treated it, is similar to news that Peloton is now going to be selling on Amazon's platform, or that they're going to be financed through a firm. Obviously very, very different, but at a very high level, my point is that simply by being a part of Visa's network, Galileo can exploit that, and their awareness, and as a result, their business revenue is going to shoot through the roof, simply due to the network effects of being a part of Visa's network. Now look, there's a ton more technical details around Galileo being involved with Visa, which I'm not going to get into in this video simply because I want to keep it accessible to everyone, not just banking professionals. But at a super high level, integrations such as these ones and the awareness for the brand associated and the network effects will be the biggest selling points for Galileo as a result of this. Moving down now to the main bulk of this video is earnings is coming soon. On Tuesday, the company released their earnings details, and immediately something jumped out at me. This was the first time ever that SoFi is going to be reporting earnings pre-market, and earlier than we expected. So we initially thought that they were going to be reporting sometime around November 9th in after hours, and now they changed that to say November 1st at 8 a.m. Now this shift in time is really interesting, right? Because it's in line with the major banks in two reasons. Number one is the banks really kick off earnings season. They're the ones who report first, before big tech, before all the small cap growth stocks. Banks kick it off. And number two, banks generally report earnings before the bell, whereas tech companies, so for example the FANGs, they all report after the bell. And so this shift alone signals to me that SoFi is starting to emulate that pattern more closely. Perhaps they're aligning themselves more in the eyes of analysts with major financial institutions and less so in the small cap tech company, high growth space. And look, I think this shift also, it's subtle, but it also has the potential to be influential, because imagine the analysts who over the next several weeks will be attending all of these sessions for the major banks, and all of a sudden SoFi is also in that bucket as well. It's going to be an easy mental association for them to make in their mind. And this time shift can also be really interesting, right? Because we can see the market's reaction as soon as SoFi reports earnings. Sometimes companies that report after hours can have their momentum killed because those companies essentially have to wait for the big volume to come in on the next day. In that period of time in between, you can have news come out, you can have some big macro event happen, you can have all kinds of different things that can kill that momentum. But if SoFi reports before the bell and they beat earnings, then you can have a strong momentum rally all throughout the day, right? So just that shift alone really is priming a momentum-driven rally in SoFi on earnings day. Because for the last couple of quarters, SoFi has been rallying on their earnings. Last quarter, for example, they had a double beat. They even raised their guidance for Q2, and the stock rallied from $6.2 to over $8 per share. Obviously, this is all predicated on SoFi having positive earnings for them to actually beat their analyst expectations. But assuming that they do, it's just a better time shift in my mind because it allows for a further momentum throughout intraday trading. And personally, I think we have a good framework of what we can expect over the next earnings. The news that we've gotten over the last earnings has been around the student loan moratorium ending. I think that's the biggest piece of news. Biden came out and said as of January 1st, we're going to resume student loans, which is SoFi's biggest business segment, which will spark a refinancing surge similar to the one back in Q4 of 2021, where people were rushing to refinance because rates are going up. NFL season has started, so we're going to have more SoFi advertisement, more search volume. SoFi checking and savings accounts increased their APY to 2% and then again to 2.5%. Anthony Noto reaffirmed options trading is on track for end of year, which I'll be listening into the call for more details on. He also mentioned that the buy now, pay later product, Pay in 4, is coming soon for SoFi, which is powered by Technisys and Galileo. On that front as well, there's a lot of partnerships for Galileo with Visa that we just talked about, Blink for insurance, DataVisor, and a whole bunch more that we've covered over the past several months. There's also been news around other major fintech players. Most recently, a couple weeks ago, we had PayPal that really stepped in it when they released a policy change that basically allowed the company to withdraw their funds at their discretion based on what you can say. Obviously, this led to many people wanting to cancel PayPal. The hashtag became trending. It caused this downward spiral, and ultimately someone came from PayPal and said that was a mistake, to which people responded, yeah, it might have been a mistake that you actually publicized it, but the fact that it was written out in the first place, that couldn't have been a mistake. And look, that might sound like a nuance, right? But the nuances start to add up. The thing that comes to mind for me is Robinhood, right? In early 2021, when Robinhood basically canceled the buy button for GameStop shares and caused that crash. It caused a whole bunch of hearings, but it also caused a whole bunch of people to start canceling Robinhood, to have a negative association with Robinhood. And what happened? Robinhood started bleeding users, and SoFi actually benefited from that, of the people who were switching. And so I think, similarly with PayPal, to a much lesser extent, but still the bad news for all the competitors is obviously by association good news for SoFi. And I think despite all of these company-wide events and news and all of the things that we've seen over the past quarter, SoFi stock is still down 40% from last earnings. Ultimately, I think all of that is macro driven. Right now, we're in a place on the macro where investors are more looking at the CPI reports and the Fed minutes than they are looking at individual company balance sheets. And that's just a consequence of the market that we're in. Obviously, that provides an opportunity for a company like SoFi, especially if they beat their earnings. In terms of what's expected for SoFi in the third quarter, they're expected to report negative 10 cents EPS and $393.5 million in terms of revenue. As we can see, SoFi has been beating all of their numbers all throughout 2022 and even in 2021 as well. This is despite the student loan moratorium. So with that coming back, we expect them to continue to be beating those numbers. And just judging from past numbers, we can also see how SoFi drives this home. They really blow expectations out of the water. We know that they raised their guidance for the second half 2022. between 830 to 835 million, representing a 49 to 50% growth, with an EBITDA between $75 and $80. And for the full year 2022, they raised guidance to 1.5 billion in revenue and 104 to 109 in adjusted EBITDA. And so just looking at their second quarter, they had a range which I believe they raised guidance from Q1 to get to that range in the first place. And they still came in and they beat that range by a pretty solid amount, beating their high estimate by 16 million in net revenue and also beating their EBITDA estimate by $5, which is very difficult to do. And ultimately, this sets my personal expectations much higher than what the street is probably looking at for SoFi. So let's now just take a look at some of the numbers. This is their growth in total members, growth in total products, lending products, and FinServe products. What I don't have here is the Galileo numbers. I also don't have any of the company financials or metrics, but I just wanted to run through some of the numbers for you. Total members was 4.3 million. This grew 11.6% quarter over quarter, pretty in line with what they've been growing in 2022, 11% every single quarter, representing a 69% year-over-year growth. Total products was 6.5 million, growing 12%. Similar story here with regards to the total product growth, 79% year-over-year growth. Lending products was 1.2 million, 5% growth here. As we can see, lending has been hit over the past several quarters because of that student loan moratorium. Although it's been getting better, a lot of this improvement has been due to personal loans, which has been growing actually, and carrying home loans and student loans. 22.5% year-over-year growth for total lending products. And finally, their biggest segment, FinServe products, 5.3 million. FinServe products up 13.5%, 100% year-over-year growth rate here. And you can see the growth rates here year-over-year are absolutely crazy. FinServe is growing fantastic. And look, I want to just bring to your attention this chart in terms of the product mix. We can see that while SoFi started out as a pure lending company, with over 80% lending products to financial services products, that product mix has heavily skewed to the opposite, where we see this flywheel forming, where people are having more financial services products to lending products. And a lot of this has to do with SoFi actually implementing new products, right? They introduce options trading, they introduce margin trading, they introduce crypto. All of these new introductions ultimately contribute to this number, right? And so the more products that SoFi introduces, the more we expect this product mix to skew towards financial services. We're going to see how this changes in 2023 as student loans starts to kick back up, whether this blue column is actually going to start creating more parity with the red mix. And so what I've done here very simply is I've just gathered the average quarter over quarter growth per year for all of SoFi's major metrics. So you can see that in 2019, every single quarter, SoFi grew members an average of 13%. That increased in 2020 and 2021, and it's decreased in terms of how much every single quarter they're growing their members. Similar story with products here. We can see overall the first 2 quarters of 2022 have been much weaker in terms of both member and product growth. And in terms of the lending products, we can see that this has been getting better from where it was in 2020. A lot of that was carried by personal loans, which has been improving, and financial services is their best segment, growing the highest quarter over quarter, 14.5% on average every single quarter, and still growing 100% year over year. And this is why this flywheel is very important. This and basically this product mix are the reasons why that flywheel is super important, right? So total products is growing faster than total members. We can see this relationship hasn't changed ever since 2019. The numbers on the bottom basically will always grow faster than the numbers on the top. This is also a result of that flywheel. And now look, I just wanted to very simply just plug in the averages in terms of what we can expect for Q3. This is not a science at all. This is just really simplistic stuff. I just took the averages here. What is the average total member growth in 2022 over the first 2 quarters, average total product growth, and so on and so forth. And I just plugged those numbers here just so we can get a baseline idea. So if we assume this average of 11.7% growth quarter over quarter, we can get a number that is around 4.8 million members. I do think that total members will be growing a little bit faster than this. I wouldn't be surprised if we actually saw total members be around 4.9 or even 5 million. But I think at the very minimum, I would expect it to be about 4.8 million, which would represent about 65% year over year number for total members. Similar story here for total products, right? If we assume 12.6%, which is the average of these two percentages, we come up to 7.4 million total products, representing a 73% year over year growth. So for total products, I think this would be pretty much in line for a conservative estimate, 7.4 million products, up from 6.5. Lending products is something where I'm going to have to say it's going to be a little bit higher. Although with the average of 5.5% quarter over quarter, we can get to 1.2 million lending products. However, remember that the student loan moratorium is ending, and that's probably going to lead to more people refinancing. And so I would assume that this number is actually a little bit higher than what we have here. But still, this would be an accelerating growth, keeping with the trend that we've been seeing. So 13, 15, 17, 20, 22, so on and so forth. If we assume a 5.5% quarter over quarter increase. Why am I doing quarter over quarter? There might be seasonality concerns in place. Yes, but it's more accurate, I think, to get more granular than year over year because of all of the things that can change on that basis. Finally, for financial services products, we're assuming 14.5% growth here to 6.1 million total financial services products, which would represent about an 89% year over year growth rate. Now, all of that was very imperfect math. It was just baseline assumptions and going from there. And we're going to be seeing how those numbers actually match up when SoFi ends up reporting their third quarter earnings in a couple of weeks here. At a high level, I do expect the business to be beating earnings. I think the evidence that I put up of them beating in Q2, raising guidance, beating in Q1, raising guidance, and especially the fact that their base case for SoFi was that Biden would extend the moratorium until the end of the year. And the fact that now we have an end date to student loans should push us in the direction that it's also going to be positive for SoFi's guidance numbers as well. I wouldn't be surprised if the business comes in at 5 million members and 7.5 million products. I think the conservative estimate for me is going to be 4.8 million members and 7.4 million products. But ultimately, we'll see. I think that time will prove that these numbers that I put up on the screen are going to be very conservative, especially knowing a business like SoFi. For more SoFi related content, do make sure to follow the channel. Subscribe if you aren't subscribed already. Share this video out with a friend, and let me know what you think of it in the comments below. For right now, this is the Fundamentals of Investing podcast. Thank you so much for listening.